Another interesting and challenging area of the syllabus concerns managerial short-term decisions. Now, one of these analyses that we need to think about is the so-called cost-volume profit analysis, more popularly known as break-even analysis. Now, what do we mean by break-even? It's the level at which a company operates where it makes neither a profit nor a loss, or we could say where profits are equal to zero. In other words, revenues are just enough to be able to cover costs. Revenues equal to costs. In order to be able to look at this in a slightly more sophisticated way, we need to understand how costs behave. When we have fixed costs, and we also have variable costs in a company, we already know that the variable costs, they go up as revenues go up. The fixed costs remain the same. So obviously, if we produce zero, we have zero variable costs, but then we have the fixed costs, which will be equal to the loss in our company. Therefore, we have to find at what number of units we have to achieve a certain level of revenue so that the revenue is just enough to cover the fixed costs plus the variable costs. So it's basically an algebraic calculation. Some people can use algebra to calculate break-even levels. Other people like to see things more in a visual way. I leave it to the candidate to decide how they best perceive the situation. What I'd like to do here is to use marginal costing concepts as a way to be able to calculate the break-even sales level of a company based on a specific scenario. So have a look at the scenario here and let's discuss. Okay, so the numbers here tell us that for every item, every unit that we produce and sell, we get $120 for it. And the costs, the variable costs associated with that item add up to, these are the production costs, 72 plus distribution and selling, they're variable, $2, that makes $74. And therefore the difference will be $46 per unit. Any idea what this is called, the $46? You're right, it's called contribution. And in fact, contribution becomes the basis for being able to cover our fixed costs, which in the scenario is the sum of the fixed production costs and the fixed selling general administrative costs, which comes out to $23,500. So the question is, how do we compute the number of units that we need to sell in order to just cover our fixed costs, i.e. achieve the break-even? If we divide $46 into 23,500, this would give us 511, and that would be the number of units at which we would reach the break-even. Let's just test it. If we produce 511 units, we will achieve revenues of at $120 per unit. Let's just multiply that through, of $61,320. At 511 units, what's our cost total? Well, it's going to be $23,500 of fixed costs, and the variable cost associated with 511 units will be 511 times $74. Let's just multiply that through. That gives us 37,814. There may be a rounding difference in here. We won't let rounding differences disturb us or establish the principle. And the answer is the costs come out to 61,314, which is near enough to 61,320. That's near enough to a break-even level as we can get, given the fact that we had to round this answer to the nearest whole unit. The mathematically, the answer actually comes out to 510.8 units, but does it make sense to produce and sell 0.8 of a unit? You can see here the mathematics are done to confirm that this in fact is the answer. Now let's just take this a step further and talk about the contribution per sale, the CS ratio. Based on the numbers that we have calculated above, for every dollar sold, how much contribution are we making? For every $1 sold. Remember, when we sell one unit, we make $120 of revenue, and the contribution per unit is 46. So if we divide 46 by 120, the answer will be 0.38, just a little bit over 38 cents. That is what we call the CS ratio. Now, why is this important? Because by dividing our fixed costs by the CS ratio, we can determine what the break-even point is for the company in terms of sales revenue. In fact, we've already done that, haven't we? We said that, let's just do the calculation here. Fixed costs, 23,500, divided by 0.3833, that's our CS ratio, will come out to, let's just pull out our calculators and verify. It's always good to verify these things. 61,310. I'll just round off the number. That's what we have here. Does that number look familiar? If we go back up here to the calculation we made before, the 511 units, that was the number of units at the break-even level, times 120, which is the selling price per unit, is 61,320. Again, allowing for a rounding difference, we've effectively determined the break-even revenue level for the company. Okay, let's move ahead to some other review some other short-term decision-making types of problems. These are actually issues which have been covered in the management accounting paper, MA2. So this is really a review. Bear in mind, for example, when we have limiting factors that are present in production processes, then we need to work around the limiting factor in order to be able to optimize our production and the benefits that result. You'll recall this following example here, which talks about 3 products in a company for which we can calculate contributions per unit on a unit basis. So contribution per unit, we can see $15, $16, and $20. It would appear that if we had no limiting factors whatsoever, we would be able to maximize our returns by focusing on just producing and selling as much Z as possible. So if we had unlimited demand for these products, Z is clearly the winner. Now let's impose a limiting factor that changes our view on this. Suppose we were to say that the labor hours that are necessary to produce those products are limited to $500 in total. And here, crucially, we're going to add in a piece of information, number of hours that are required to produce each unit. Now notice here that to produce 1 unit of X, it requires 5 hours of labor, whereas to produce Y, it requires 8 hours, and Z, which was our most profitable or greatest contributor as a product, requires actually 10 hours per per unit. Now this may change our perception as to which is the champion product we should be prioritizing. The key thing here is to calculate what the contribution is per unit of the limiting factor, in this case per labor hour. And here we can see very clearly that X now looks most favorable. If we have a limitation on the number of labor hours available, we would want for every labor hour that we use of that scarce resource, we would prefer to generate $3 of contribution than $2, which would be the case for Y or Z. So we can see now that X looks like it becomes the priority product. This is very important, these sorts of questions, to be able to focus in on the relevant factors in order to optimize production. Here's another typical question which works on the basis of, it's a typical make-buy calculation. I'll leave this for the candidate to read through and come to his or her own conclusion as to whether it's worth buying externally, outsourcing the heaters, or producing it internally.